Good afternoon, everyone. We'll just wait for a few seconds as we're waiting for everyone to trickle in. Thank you for attending today's webinar. It's really informative, really interactive. So by all means, have your questions ready, and we'll be more than happy to address them throughout the presentation as well. Some housekeeping items. The webinar will be recorded. At the end of the presentation, we'll be able to email you the presentation and also the YouTube link as well. So if there's any questions, concerns, anything that we can be of assistance to assist your small business needs, by all means, contact our colleagues from branches and also from the Florida SBDC at FIU, as we're here to assist you at no cost. All right. And allow me to introduce you to Mr. Steve Armin, that will be talking more about the branches programs.
Hi, everyone. So grateful that everyone has been able to join us this evening. Really happy that you're here. And I know I speak on behalf of the panel when I say that we too are really excited about this training that we have for you this evening. So as Jesus said, I'm just gonna let you guys know a little bit about branches. For those of you that was here for the training last week, you'll be familiar with these slides, but this is really for those that are new, that is not really aware of what we do at branches. So today's training is part of our fall training program here at branches. We do have a micro business program, and in this program, we do have an incubator where we help businesses in various stages of their life cycle to be able to transcend the issues that they're facing, the challenges that you're facing that are unique to your business, that is unique to your industry, that is unique to your markets. Whatever the challenges that you're facing at this point in time, you know, in terms of the life of your business, branches, and of course the SBA Navigator is here to help. So today, yeah, for some strange reason, the slides I'm going to stop sharing for a minute, Jesus, and I'll start back.
That's not a problem. In the time being, by all means, introduce yourself in terms of what small business, do you have a small business? What are some challenges that you're experiencing? So like that, I will be able to see what are some possible events and workshops that could benefit and to address those needs as well. So just in the chat, by all means, put your name, what business you're in, what industry, and there's a great opportunity to network amongst other participants as well.
Right. So it's working now, Jesus. Yeah. So at branches, ladies and gentlemen, we use an approach that we call the people-centered design, and branches is an agency. It's a nonprofit that looks after community needs from the perspective of the whole family. So within the people-centered design, we use something called the 2-generational approach to supporting families, which means that we work with the children in the families and we work with the adults. Where we work with the adults, right, that comes under our strategic focus of helping people become independent financially. And one of the ways we help them become independent financially is through our business program. So we do use something in the business program that is referred to as business-centered design. And in the business-centered design, what we do is that we work with your business according to your particular needs. So as part of what we do, we will baseline your business with you. We will do a deep dive in terms of a scan as to exactly what it is you need and what are the challenges you're facing, and we will work with you on the solutions. For anything that branches cannot do by itself, we engage the support of the SBA Navigator Network, And we do have partners, as you're seeing here today, with SBDC FIU, that we call upon every now and again for assistance, all designed to help the businesses that come before us get the solutions that they need, either to overcome challenges or to harness opportunities that's right in front of them. At Branches, we look at the knowledge that we share and the training and the consulting that we share according to 4 pillars. We have, as one of the pillars, so think about it as the legs of a table. We have entrepreneurship, we have business systems, we have digital transformation, and we have business intelligence. Each one of them speaking to a category of training and support that is highly interrelated. So even though we have it as 4 categories, there's nothing that you do in business that is not related to something else. So for instance, today, with the accounting training that we're doing, that falls under your business systems development. And next month, the month of October, we'll be working with businesses through our training on your digital transformation and your marketing. And in November, we'll be working with you on your business intelligence and your business planning. So this is just to let you know that we do have as our pillars these 4 categories of training and support that is designed to help businesses grow and thrive. And for the month, as I was saying, for the month of September, this is our business systems training with an emphasis on business accounting. And, you know, I always say, if business was a culture, accounting would be the language that you speak. Marketing might be the clothes that you wear, but the language that you speak in the culture of business is accounting. And today we are going to be, we are in the 2nd training for this month. We would have started last week with business basic accounting in 60 minutes. And today we have accounting that's made easy for you. And next week, the webinar continues because we elaborate upwards. The training that you have today is going to make the training that you have next week that much more applicable to you and to your particular business needs. And then we culminate this month of training with an in-person workshop titled An Introduction to QuickBooks, which is putting together all of the knowledge you'd have gained in this training over the last 3 webinars into a workshop that we hope is going to help you to understand how to use a tool that is going to make your life very easy when it comes to accounting. Today, I am very, very honored to introduce our star presenter, right? Our expert of the evening, Miss Lillian Urband, who would have also shared her knowledge and her experience in the training last week. And she'll also be the one that's doing the webinar next week as well. Lillian is a graduate of FIU. She has a bachelor's in accounting and a master's in taxation. And she's also a certified QuickBooks advisor. So today, this is just so that you know, these are some of the funders and the donors and the partners that we have that makes it so much more easy for Branches to do the work that Branches does. We could not be who we are, we could not help the way we do without the companies that you're seeing in this slide. So I did want to have a shout out and let you guys know that we are part of a network of support. If you come to us at Branches, we will support you in the way that we feel is best, suitable to you and to the work that we do. And if there's anything that falls outside of that, we reach out to our network for support and we find you the help that you need. So without much further ado, I'm going to hand over to Lillian. Again, I want to say thanks in advance to Lillian and Jesus for helping us at Branches present this workshop for you today. So Lillian, thank you. And it's off to you now, Lillian.
Lillian, you're on mute.
Thank you, Steve, for the introduction. This webinar, it's a follow-up of the one that we had on September 6th. It's going to help us determine the accounting part of it, which is very simple. Oh, I guess because I've been doing this for 25 years, it makes it simple, but I have a technique of teaching you that I taught the same thing to professionals of different countries at the University of Miami, which was very simple. They didn't have any background in accounting, but it will help you understand what we do. Again, my name is Lillian Norvant. I'm a business consultant for the Florida SBDC College of Business through the Miami-Dade Business Navigator program. A little bit of what we do, we provide, let me tell you about the Miami-Dade Business Navigator program a little bit. The Miami-Dade Business Navigator program is funded in part through a cooperative agreement with the United States, with the SBA, the USA SBA. It was established by the American Rescue Plan Act of 2021. The Small Business Administration Community Navigator Pilot Program uses a community navigator approach to help small businesses with economic recovery. The program is comprised of a lead hub at the center of a network of spokes, where branches is one of our spokes. These organizations deploy community advocates to work with the small businesses on recovery and resilience. And the goal is to improve long-term economic recovery and resilience among small businesses. The focus is placed on businesses owned by veterans, women, as well as socially and economically disadvantaged individuals. Here's some of our spokes. And as you can see, branches is here: Ascendus, EDC of South Miami, Miami-Dade Chambers of Commerce, Prospera, Startup FIU, and of course the SBDC. What is the Miami-Dade Business Navigator program? It's a continuation, it's a coalition of partners that secured $2.5 million via the Navigator program to create the Miami-Dade Business Navigator program for Miami-Dade County businesses. We focus to create a strong local community navigator network to assist socially and economically disadvantaged businesses with consulting, mentoring, and training at no cost to you. What does the Navigator partners? We target minority-owned businesses, women-owned businesses, veteran-owned businesses, and LGBTQ-owned businesses. Before I start, I would like to make a disclaimer, the same as I presented before, and I'm not going to read the whole thing. The bottom line is you have to follow certain procedures in accounting. There are standards to report accounting and financial reporting. And how do you follow those procedures? We follow the generally accepted accounting principles, which is GAAP. You are going to hear me, if you become my client through the Navigator program, you would always hear me say, follow GAAP, follow GAAP. Now, you can subscribe for free and get some information from them. The latest information that they have. What is GAAP? GAAP is a set of standards that companies, nonprofits, and governments should follow. If you notice, it says all companies, for-profits, nonprofits, and government, to present and prepare financial statements, including several transactions that has to be footnotes on the financial statements. What are the financial statements? Financial statements are a set of reports where accounting information is communicated to others. The people, the users of this communication will be internal or it could be external. Internal will be management, External will be if you're going for a loan, and that's what the state was talking about. When you go for a loan, they want to see some financial statements, at least the balance sheet and the profit and loss statement. The financial statements are formal records of the financial activities and position of a business presented in a structured manner in a form which is easy to understand. They had to be, and this comes from GAAP. Whenever any user reads a financial statements, it has to be understandable. That's why we have to follow GAAP. They had to be relevant in the sense that is related to the type of business that you're in. Consistent. It has to be compatible to the industry that you're in. And they have to be reliable, meaning if you put some bad information, let's say you use QuickBooks, whatever you put in that's what's going to show up on the financial statement. So we had to make sure that we do it properly, and that's where we come in through branches in the Navigator program to teach you how to work with systems like QuickBooks to make sure the information is properly coded. And it has to be objective. Any business owner should have the basic understanding of three key financial statements. One is the balance sheet, income statement, also known as profit and loss statement, and the cash flow statement. The ones that you will be using the most internally and externally for other users like banks, it will be the balance sheet and the income statement. Cash flow statements is hardly used for the purposes of a day-to-day activity. Financial statements come from a formula that was created many, many years ago by someone that's all he did. He was a mathematician, and he created the debits and credits. If you see it, it's like a T account. It's called T account. And always, always on the T account, on the left-hand side, it always will be a debit, and always on the credit. I need you to memorize that. We are not going to cover so much about journal entries, but you need to understand, because if you buy QuickBooks, QuickBooks does all the work behind the scenes. Because when you open QuickBooks, you are going to create a check when you're paying someone, but literally you're doing some debits and you're doing some credits. So to memorize this slide, you need to know that all assets will increase when you put it right here on my T account. And what are assets? It could be bank accounts, it could be accounts receivable, it could be prepayments you made, it could be inventory. So they always increase by a debit entry. Liabilities, as you can see on the accounting equation, assets always must equal the sum of liabilities and owner's equity. So if assets increase by a debit account, how would it increase by the liabilities and the owner's equity? How would they increase? They will increase always, always on the right-hand side of your T account. Please memorize this. You're not going to use it much, but eventually when you get good at accounting, doing through QuickBooks, there are certain activities that you will not be able to enter it through their system. You will have to enter them through journal entries. So on the credit side, that it would always increase, we have the liabilities. Liabilities always increase when you do credits. What does a credit on? It's a liability. It could be a credit card payment, money that you owe. It could be a notes payable. It could be a mortgage if the business owns a property. It could be anything that you owe money to, including the shareholder, because sometimes the shareholder lends money to the business. So it will always increase by crediting the account. And again, I'm reiterated, please memorize this. Owner's equity, it always increases on the credit side. What is owner's equity? It increases by the capital you invest in the business. It increases by contributions you make to the business. It automatically increases when there's an income in a period. And that's the formula that says assets equals liabilities plus owner's equity. If you memorize this, you will be set. You will be set to learn in the future when we do some journal entries after you get your business going. We can go in and teach you how to do journal entries. But if you memorize this, it's going to make it easier. So again, assets increase by debiting an account, liabilities increase by crediting an account, and the owner's equity increases by crediting the account. Let's go back to the accounting equation. What is the accounting equation? A transaction is an exchange between at least two accounts. The term debit and credit is used to describe transfers to and from an account. Now, I call it debit in here and credit because I don't know what account it is, but we already know if the asset increases by debiting the account, it could be a bank account. It could be an inventory account. When recording a transaction, you must ask and you must answer these questions. Again, QuickBooks does it on the background, but you need to understand where it comes from. What accounts are being affected by the transaction? You will learn that through QuickBooks. I believe you guys are having a class where they will teach you about the chart of accounts. The chart of accounts is the type of accounts that QuickBooks gives you automatically to run your business. But with you having a specific industry, there are additional accounts or types of accounts that we can add to it. What type of account is each account? We're going back. Is it an asset account? Is it a liability account? Is this an owner's equity account? Liability is very simple. Money you owe. Doesn't matter to whom. Owner's equity is a little bit, it has more detail because it has the capital you invested, the common stock you invested, the net income that increases your equity account. The third question you should ask is the account balance to be increased or decreased. That's where when you memorize this, you would know, because you know that you have to increase an asset by debiting the account. But if you're paying something, let's say the debit is the bank account, it always increases by debiting the account, right? And then if you pay something, what is the opposite of debiting? Is moving money out of the account, so it's going to be credited. I will give you a couple of examples in a few minutes. How is the type of account increase or decrease? How? Very simple. For every debit, you have to have at least one credit. The balance, the T account always has to be in balance. Let's say, and I'm going to go by the example I have in here. Let's say Mr. Smith buys a computer for $3,500, but he only has some money. He doesn't have all the money in the bank. So what is that he do? The equipment, remember, equipment is a debit. The cash, he paid all in full, $3,500, but he made a mistake. He put accounts payable to pay $2,000. That cannot be. This is a way of showing you that there is an error, because what did I say? For every debit, there has to be a credit and it has to balance. So if the person bought the computer or the equipment for the office for $3,500, what are we doing in here? The equipment is a fixed asset. What is it increased by? Debiting the account. But look at the question. This is very important. It says that he paid $1,500 in cash and the balance in accounts payable. But he made a mistake. We can see it right here. The equipment is cost $3,500 because it increased by debiting the account. He paid $1,500. So what number should be here? 1,500. And he paid the difference on accounts payable. So the sum of 1,500 plus 2,000 should equal. In this case, it's not only one credit account that was affected, it was two accounts. But this is a real example of the errors that people make. This is a true example of people that put the cash 3,500 when we know, and it's just not because it's written up here, and it's because you know the debits and credits have to match. So the total of your debits should be 3,500 and the total of your credit should be 3,500. And the way you can find these errors is running journal ledgers. We talked about it the last class. We're not going to get into it, but I just wanted it to show you the error in here. Then we have, let me see if I can move that right here. Then we have the Mr. Smith pays the 2,000 accounts payable. So if you notice, if this was done right, the 1,500, let's make the assumption that it was done properly, $1,500 here. Now he's paying the $2,000. So what happens? Remember, liabilities increase by crediting the account. Credit the account. But I'm paying, so what happens? It's a reverse, right? I'm paying, so this comes to be a debit, and I'm taking money out of the bank to pay that liability. So if you notice, this is a balance. My debits and the credits equal. What's the error in here? It's not on this transaction. It is on this transaction where they put cash of $3,500. And it was done in purpose so that you can see the error. The sum of your debits had to match to the sum of the credits. And how can you determine whether you did it right or wrong? Because you can, just add up a little bit here and you notice that this is $5,500. It does not up to $3,500. Another example. Mr. Smith opened his law practice investing $5,000. He decided that that was his initial investment. Remember the formula, assets equal liabilities plus owner's equity? Here we go. He invested in the business. Money goes into the bank account. The cash goes into as a debit. Why? Because assets increase by debiting an account. And capital increases by crediting the account. So if you add the debits and the credits, this account balances. This is a concept that is very abstract because QuickBooks doesn't do it for you. But if you learn the basics of this, you will be able to understand when there are errors on the financial statements. Because if you have a capital account that has a negative number, that means that it was entered backwards. Just like the prior, just like this entry, it will give you a negative number. Now, the same person, Mr. Smith, he did not invest $5,000. He lended to the company $10,000 with the check. It does not matter how he does it. I just wanted to make a distinction between cash and the check. What's going to happen? The money is going to go into the corporate bank account. Cash increases by what? Debiting an account. Debiting the account, so the cash means bank account. It increased by $10,000. Now, in here, because it's a loan that Mr. Smith is lending the money. Now, Mr. Smith, I don't know the type of company the person has, but it could be a shareholder or it could be a member. It has shareholder / member. It does not matter. It should say loan from and the person's name. If it is a loan, where do liabilities increase? We saw it in the formula that said liabilities increase by crediting the account. Crediting the account. So if you notice, my debits and my credits are in balance. Now, let me give you an example of a company. These are real numbers. This is an example of a balance sheet. And there's a couple of things that I need you to consider. This chart of accounts comes from a set already chart of accounts specifically for this company, because it did not come with certain areas like the credit card number 1, credit card number 2. You have to add it. And that's the beauty of QuickBooks, where you can add the information and the type of account. But if you look at in here, we have current assets. We have the checking account. And this is what I like to do. I like to put the bank's name, the account number, and put if it is a checking, because a lot of companies, when they start, they have one checking account, but then they open another bank account. It's another checking for payroll. Then they open a savings account, so it is easier to identify. Then we have other current assets. One was current assets, the other one is other current assets, and in here it shows money that came in, but it has not been deposited in the bank. Undeposited funds is a default account where if you have not deposited, that you would learn once you learn QuickBooks, you will learn that when you create an invoice, you apply the payment, that payment goes into the undeposited funds, because the payment could have a date of, I don't know, September 15, but you make the deposit in August 15. So this money remains in here until you are able to put it in the bank, because when you reconcile the accounts, you need to match what is in QuickBooks with the bank statement. So the undeposited funds is a catch-all account until the money goes into the bank account. And that gives you, you see, you have current accounts, you have other current accounts, and then you have total current accounts. It just gives you the sum of these two, the 1699, 6.66 plus the 750, and these are your current assets. Assets are liquid, meaning savings account, cash accounts, petty cash accounts, cash on hand accounts, checking accounts. That is liquid, that you can go to the bank and take out the money. We have also under assets, we have accounts receivables, we have inventory, but they are not as liquid as cash. Liquid means you can go to the bank and take the money out. Where the other assets like inventory, accounts receivable, you have, if you sell, it will take you a little while to sell to get that, so they're not liquid assets. Then we have the fixed assets. Under the fixed assets, in this particular case, the client has office equipment, it has a computer, and it has an automobile. Now, this cost right here, this is the most important part that you have to learn. It is the cost or the money you paid for that computer, the money you pay for the automobile, the money is the money you pay for the furniture. You need to include the cost. The key word in here is cost. It has to go at cost, and this cost will include, let's say, for the office furniture, you paid $500, but they charge you $75.61 to deliver it. So guess what? The cost of the computer is the cost plus the delivery. The same as for the computer. It includes the cost plus the sales tax. And if they deliver it to you and they're charging you for the delivery, it has to include in here. Key ingredient, memorize that is at cost, And then we have the annual accumulated depreciation. And what I need you to emphasize, is that accumulated depreciation is usually done manually, where your accountant will send you the journal entries, and you will have to enter them through journal entries. That is the reason why I emphasize on learning how to manipulate or work with journal entries. Because if you notice, the accumulated depreciation is a negative number. And if you realize the balance sheet is as of certain date. When you go to the bank for a loan, they're going to ask you, oh, give me the balance sheet for year 2021 and a year to date. You always, if you're in the calendar year and the fiscal year, you close at the end of the month of December, it will always read December 31st and the year. But if you're doing a year to date, it will say as of, let's say we close it as of September 30, it will say as of September, and it's cumulative. All your assets, all your equipment will show up the same unless you buy more equipment or more fixed assets. Everything balance sheet, the balance sheet is is cumulative. And there's no relationship of analysis. What you can do is you can analyze, and I just got all the way to the fixed assets only because I wanted it to go over certain things. You see, this is December, at December 31st, 21. This is at December 20. What is the change? What happened during this year? In the bank at December 2020, I had $2,791.85. But as of December 31st, 2021, I only have $1,669.66, meaning there was a change. In other words, I had less money to, what happened? What happened? That's the analysis you have to say. What happened? Why don't I have enough money? This number should always be positive. That means that if you go into the analysis, you're selling more, you are not spending too much in expenses, but we will get into the analysis in a little bit. But I just wanted it to bring you to your attention that a balance sheet is a cumulative analysis, is a cumulative report that it gives you information as of certain date. Let's go into other assets. I'm still under the current assets. I'm still under the assets column, and I have organizational costs and accumulated amortization. Well, it seems that this company, they only invested $87.50. It was organizational costs. They didn't pay an attorney. They didn't pay anyone. I don't know what they did, but they already amortized the full amount. So if you notice, the total assets for the year 2021 is $14,979.90. As of December 31st, 2020, the total assets were $17,318.84. What happened? And this is where the analysis comes in. If you notice, your total assets is 100%. So you look at the analysis of the balance sheet backwards to say, okay, if my total assets are 100%, what percentage do I have into the checking account? It's 11.15, because the sum of this, it has to add up to 100%. You do it a horizontal analysis. Horizontal, because you're looking from the 100%, and you see the percentage that is being affected. What is the percentage of the analysis between 21 and 22? And these are differences. Now, on the formula, we have assets equals liability and owner's equity, right? So we go back to our formula, and now we have the total assets. The total assets are going to equal liabilities plus equity, which are the capital accounts. So if you were just looking at the assets, where would you know that all these accounts increase by what? By debiting the account, by debiting. You don't see it, but just memorize it, that assets increase by debiting the account. When you do QuickBooks, it will make it easier for you to understand it. Liabilities, this company has a couple of credit cards. And if you notice, they all have positive numbers, right? If they do. If this was a negative number, something is wrong. Just like that example that I show you. something is wrong. This particular company owes money, and in this case, it did really good because in 2020, it owed $845.42. And on December 31st, 2021, it only owed $197.53. So this person is paying their credit cards on time. The liability, by the way, these are in the millions of dollars. It just shows the small amounts, but these are in the small amounts. If you look at it, this means that the bank might look at it and say, oh, you know, it's good. This person doesn't have too many liabilities, too many debts. Other current liabilities, it could be that the client paid you more than you were supposed to receive. So what you do is you owe them money. A lot of clients, they think that just because if you sell something for $40 and they give you $45, you're to keep those $5. No, you have to return it to the client. That is reliability and being honest with the client, saying, hey, you paid me $45. It was only $40. I owe you $5. And I'm going to put it on my books as a liability until we can reverse it and I can use it for something else that you're buying from me. Then we have, remember, the liability of a shareholder or a member can lend money to the company. They can lend money to the company, and I put shareholder and member, but in reality, it should be the person's name in here. And in this particular case, the shareholder lent the company $31,179. Where would that be on my T account? That will be in the credit side, right? Because it owes money. The same as for the payroll liabilities. And in 2021, this company did not apply for COVID, but it did apply in 2020. So it owes that money because it has not been forgiven yet. Again, it's a liability until it's forgiven. The company owes that money because it was many times when the company thought it was going to be forgiven, but then the bank did their due diligence after the fact, and they say, no, we cannot forgive you. The SBA is not going to forgive you. You owe us the money. So you might as well, but that's accounting, that's following GAAP. You have to put it in the books as a liability. Let me just go up a little bit here, and you will see in here that the liabilities include current liabilities, other current liabilities, and then it gives you a total of liabilities. The equity account, and I believe we're missing a little piece in here that it should be the sum of the current liabilities plus the total equity has to give me this total, the 19,979, because on the formula says assets equals liability plus owner's equity. And therefore, the liabilities have to add up. The liabilities plus the total equity is going to give me the same amount. In QuickBooks, many times, it doesn't happen too often. I have noticed that in QuickBooks Enterprise, which is the largest software version QuickBooks has for large companies, that the total assets do not equal the total liabilities and equity, but there's very easy to fix. I have done it for the clients and I teach them how to do it, so don't worry about it. But your concentration should be, and this number should be at the bottom. It says only page one of 2, so page 2 is missing. I apologize for that. But it should be the number in here. Now, if you add up the percentage of the columns, it should give you also 100% in here at the bottom. The last column, this is percentage of column should add up 100. So the analysis is, what percentage of my liabilities on my credit cards am I spending? And it's 0.42%. You are spending of the liabilities, 0.42% is what you're using for the credit cards. This is an example of a gap through CCH, which is a institution that provides financial statements or templates. And you would notice that in comparison to this balance sheet, this is very simple. Very simple. It doesn't have that much. It only has a checking account, and it has the undeposited funds, and it has the office equipment, which are part of the fixed assets. On this balance sheet, you have the cash, the accounts receivable. Usually, when you have accounts receivable, that means you're entering invoices. That means that you are on the accrual basis of accounting. We covered that on the prior class. When you have accounts receivable, you're allowed to deduct, because many clients don't pay you. So you are allowed to put a reserve for bad debts, meaning, oh, okay, I don't think I'm going to get paid, but let me put a little reserve in here to make it work. We have the merchandise inventory. We have prepaids. They're all notes receivable. Those are all current assets. Then we have the fixed assets. If you look at it here, the presentation is a little bit different, which a lot of people don't use it anymore. I would say we don't do it. But we have the vehicles, we have the furniture, we have the equipment, we have the buildings, and we have the land. If you look at the balance sheet in here, it only says fixed assets, office and equipment, computer, and auto gives you a total of fixed assets, and then you have the accumulated depreciation. And here it provides your accumulated depreciation per item, per vehicle, the total of all the vehicles that are being depreciated, the total of the accumulated depreciation of the furniture and fixtures, the accumulated depreciation of the equipment, the accumulated depreciation of the building. Land is not, you do not take out depreciation. Never, never. Land is at cost. You also have part of this current assets, which is part of your total assets. You have goodwill. At the beginning of your business, you will never encounter with goodwill. But let's say you're in business for 10 years and your name becomes very well known. Now you're not only selling your business for the number of clients you have, the portfolio you have with your clients, you're selling the name, and that is considered goodwill. What is goodwill in large companies? Let's say McDonald's, Burger King, that's goodwill. They're selling you the name as well. So I go back, current assets is half of our equation. It says assets equals what? Liabilities plus equity. So now we go to the other half of the formula, and it says liabilities and capital. And you would notice in here in comparison, I'm going to go back and I'm going to show you the liabilities in this true example. It has some credit cards, a little bit of money that he owes to the clients, a loan to the shareholder, payroll liabilities, and the COVID-19 PPP. If you look at in here, we have more items. We have accounts payable, we have sales tax payable, payroll taxes payable, which on the client calls it payroll liabilities, accrued wages payable. Usually that happens at the end of the year where you owe money to your employees. And on revenues is a liability, because even though you have not done the work, you have billed the client. Then we have the short-term notes payable and the short-term bank loan payable. That is if the business has business. This is a more comprehensive balance sheet. In your particular case, you're not going to have this, but it's good for you to know the type of accounts that can be part of the liabilities account. Then we have long-term liabilities. Long-term liabilities could be because you got a loan. It could be an SBA loan. An SBA loan is a long-term because usually they give you the interest rate for X number of years. So that will be a long-term note. But what happened is at the end of the year, if you notice in here, it says short-term notes payable, long-term notes payable. You had to make a journal entry to determine what the short-term payable was for the year. So it's an adjustment through the note, through the journal entries. That's why it's important for you to know that the equation assets increased by debit in the accounts, liabilities by increased by credit in the account, and equity increased by credit in the account. And then we have the owner's equity. Owner's equity, and remember at the beginning I said, okay, that is the capital account is going to increase by the owner's equity, could be contributions, distribution. This is just the net account, and the profit or the loss. Now, the sum of the total liabilities and capital must equal the total of the assets. And again, I apologize again, page 2 in here is missing. But what I'm talking about is that this number in here has to match the sum of the current liabilities and the equity account. Now, let's go and visit and learn about the income statement, also known as profit and loss. The profit and loss is for a period of time, meaning for the period that you close in the books. Usually is from January through December. For someone that started the business in, let's say, this month, and they already have sales, it will be a short year. And it will not say January, it would say September through December 2022. These are books for 2021. Just by looking at the chart of accounts, this accounts as part of the chart of accounts that you will find in QuickBooks, but this is specifically for this type of business. And I will make you the difference. I will show you the difference and what it is. From what I see, not only that the name gives it away, it's a service business. Because this company sells services, therefore it does not have cost of goods sold. It does not have purchases. It does not have inventory, which we'll look at the example that I'm going to give you afterwards. So we know this is a service business, and this company gives them a lot of discounts. Even though the person in 2021 made $131,417.42, it gave a little over 25,000 on discounts. If you were analyzing this business, you should say, why is this person giving us so many discounts? What is going on? Is it that is incorrectly coded instead of going into services income? They put it as a discount. So that's part of the analysis. And then we have the operating expenses. Very simple. You have the automobile expenses, the bank charges, charitable contributions, computer intranet. This is a simple chart of accounts. Gifts. Two accounts that are very important. On this account, you will not see the word miscellaneous. As I mentioned on the other class before, nothing is miscellaneous. Everything has a home. Every single expense has a home. So that's why this client does not have a miscellaneous account, but it has an account that's called gifts. The IRS allows you to give your client a gift card or basket, something that is worth $25 or less. So if this person has $305.18, it better be that the client gave 25, 25, 25, 25 to those clients, and one of them even got a little bit less than 25, right? So it's the IRS allows you to give as a gift without, and it's tax deductible in your business, up to $25. If it is more than $25, you shouldn't think about it. Don't do it because you can get in trouble with the IRS if you code everything to gifts and there's a large amount. We have insurance expense. We have interest expense, licenses, permits, meals, non-employee compensation, office expense, office supplies, payroll expenses, postage, processing, repairs, maintenance, telephone, and utilities. But then we have another account called other income. What do you put in other income? you put everything that is not business related. In the client's case, the question would be, why is it $22,000 and $914 under other income? Because under other income is something that you put that you're not in business. It just happens that you receive something. Maybe you have a gift. We don't know. And that goes back to the industry. We'll figure it out when the time comes for you to, when we review your financial statements. And interest income, you're not a bank. So most likely this 24 cents, which is very little, is the interest income the bank gave them, this company, for having money on the bank account. Now, the analysis is based on percentage of income. If you look, this is important to memorize. Gross profit, it's always going to be 100%. Always. It has to be 100% to do your analysis. So, what is the automobile percentage based on your gross profit? Is 3.58%. So 3.58% of your income is going to cover for automobile expenses. One that is significant, computer expenses, 3.45% is dedicated to have a good computer system or to have all those wonderful subscriptions like Google, Microsoft, Wixcom. Everything is related to 100%. If this is 100%, what percentage am I using for payroll in this particular case? Payroll, 101%. Wow, I only have 100%, but I'm spending most of my income on payroll. So what is going on? That is why you have negative numbers, because he took out more money in payroll than what came in. And you can tell because of the gross profit in 2021, it was only 106,250.44 cents. And the expenses were 147,340.54. So your net income, which is now called net loss, is $41,000. So literally, someone has to sit down with the client and say, hey, you're doing something wrong in here. What is going on? You're not having enough sales. You're not having enough sales. Let's talk about marketing to increase those sales, because you are on the red. Now, this is the simple profit and loss statement. The analysis is very simple. Again, 100%, what percentage of your gross profit is used on each activity of the business. Now, I wanted to show you this. This one has an account called cost of goods sold. That means that this is the chart of accounts that we will set up if you sell an item, because you need to keep track of your purchases. You need to keep track of the freight in. Freight in is what you pay to bring those merchandise for resale. Now, there's a difference between freight in and freight out. Freight in is how much it costs you, is part of your cost. Freight out is how much you pay to ship the final product to your client, and that's an operating expense. So what's important in here is to distinguish even the name. It says gross sales. It doesn't say service sales, right? So we know this company could use this chart of accounts because it's a company that sells a product. And it allows you to have a net loss allowance, a net sales return. Someone returns the merchandise, we can have an allowance on that account. We have the cost of goods sold, which will begin with the beginning inventory. We will add the purchases, the freight in, the direct labor, the indirect expenses. When you sell the product, it doesn't matter whether you manufacture it or you buy it from somebody else, somebody is doing the distribution. It doesn't matter. What matters is that you have a cost of the purchase, even if you don't handle it, because when you have, let's say, the distribution company, they're going to give you the net amount. But if you're presenting this to your investors, you need to tell them what is the cost of the product. And that's where it becomes cumbersome, because you have to have that information. You have to rely on those distributors or the person that is doing to say, okay, how much are you going to charge me for this product? Because that's going to be my cost. Are you going to charge me for freight in? Because that's going to be part of my cost. Part of your cost is going to be if you have a person working, let's say you do it online, just working on that computer every day, trying to sell those products, or building that store online. That's a direct labor cost. Indirect expenses could be part of the administration cost. It could be different things. I cannot give you details of it because, as the disclaimer says, it has to do with your business. You have to follow GAAP, and this is a one-on-one based on the type of business you have. So the cost includes the beginning inventory. You add up all these expenses and you deduct the ending inventory, and you have the cost of goods sold to make your analysis. Are you making money? Are you making enough net sales to see if your gross profit is good? In the prior example, without looking at the expenses, we know it's 100%. But when we got to the expenses, oh my goodness, we have a problem. This person is spending more money than what comes in. So that's the analysis. Then we have the expenses. And here you have a larger number of types of accounts. And if you would notice in here, they have the miscellaneous account. I don't like the miscellaneous account. That account should not be in your books because everything has a home. If it is insurance, it should go under insurance. If it is postage, it should go under postage. If it is professional fees, it should go under professional fees. And then we have, as my profit and loss statement show, it had interest income, but in here it has gain or loss on sale of assets. If you sell one of your fixed assets, and if there is a gain or a loss, it gets reported in here. So it's very simple to do. That's why we are here. It doesn't cost you anything. We can train you. We can literally train you how to read financials and how to set up the chart of accounts, specifically for your business. Now, there are some industries that the QuickBooks will not give you, and you will have to find a CPA that is proficient in that industry, and they can sell you the chart of accounts, because that CPA or that accountant spent hours and hours creating that chart of accounts, and it's not going to give it to you for free. So it has a cost. Then we have an example of the cash flow statement. Usually this is done for your purposes inside, for users inside the business, because it will take the net income. This goes back to 2020. It has nothing to do with the balance sheet and the income statement. It's just an example. It has not, because the numbers are totally different. And it has three areas. The operating, it could include in the investing, the financing, the operating activities. So in this particular case, this company only has operating activities. The operating activities will be the net income, and then you do your adjustments to the net income. And how do you do that? You deduct your accounts receivable, you deduct your credit card, you deduct your PPP, you add your PPP, because there's a probability that you will be forgiven, and you deduct your payroll liabilities. This gives you the net cash provided by operating expenses, operating activities, operating expenses, operating balance sheet. Because if you notice, these are all balance sheet accounts. And this in here is the profit and loss statement. Then what you do is you add up the beginning of the cash. What's the beginning of the cash? Again, we go back to the balance sheet, and that will be the cash. Don't worry, the cash flow statement, it can be done in QuickBooks. Once it's set up, and automatically it will do it for you. Do you have any questions?
I have one. Pretty much in the balance sheets, Lillian, where does the inventory go?
Okay, let me take you back to the presentation.
And then at the time being, if you have any questions, please encourage you to put them in the Q&A, and I'll be more than happy to moderate them for you.
Okay, here we are on the balance sheet sample with no numbers. You can see it in here. It says merchandise inventory. Remember, inventory is an asset. It's not liquid asset, but it's an asset. And at the end of the year, there's an adjustment done between what is on inventory, which I always recommend my clients to do an inventory count every month. And that applies for companies that sell products. If you are a service business, you're not going to have this account in your books. Let me give you the relationship between the balance sheet, which says merchandise inventory, and the profit and loss. You see where it says in here, beginning inventory, ending inventory. This ending inventory is going to end up right here as the merchandise inventory, as the ending inventory. And the only way to do it is through journal entries. And you should be familiar, you should emphasize that if you sell any merchandise, it doesn't matter if it is one item, but you're buying some items, you buy it for different products. You have to keep track of that inventory on a monthly basis so that it doesn't end up having a bad ending inventory at the end of the year.
And then, is there such a thing as tip? Okay, so is there such thing as tipping if the customer gives you more than what the item sells for?
Did you say the word tip?
Tip, yeah.
No, no.
Okay.
Usually you get a tip when you're in the restaurant business, right? They give you the tip in the books of the restaurant. What do? We put it in an account. Then those tips is given to the client, and because to the employee, and those tips go part of the W-2.
Gotcha.
But if you're selling a product, let's say that I buy a phone, and this phone costs $800. And because you were a nice salesperson, I give you $900 to the company. In the books, that means that you sold the book for $800, they give you $100 in addition to it, and you're calling it a tip. It's not a tip. The client made a mistake. You have to return that money. And I know a lot of clients, they say, no, they took years to pay me. I'm going to treat it as interest. Guess what? You can do whatever you want in your business, but we as accountants, we emphasize and we tell the client, listen, tell your client that he gave you $100 extra. Because you're supposed to give him back the money, as simple as that. There's no, oh, I'm going to keep it because it took him years to pay me. Except for the restaurant industry.
And then can you explain a little bit more about the depreciation and the amortization?
Amortization. Okay. Every single fixed asset in your business the IRS has a table that tells, for example, computers are depreciated 5 years. And it could be double decline or single decline. You don't do that in the books yourself. You depend on your accountant to do that because it's very cumbersome, it's very difficult. So what the accountant does is he puts it in their system, in the tax system, and they come out with a report. Accumulated depreciation will be all your assets that you have, because remember, the balance sheet is cumulative. So the same cost is going to be in the books, but the depreciation is always changing because it's increasing until it matches the full fixed asset is going to match to the full accumulated depreciation. But in your books, you have to worry about entering them through journal entries. And that's why I emphasize so much about journal entries. Now, if you become our client, we can teach you how to do it. I've done it for some of my Navigator programs, and they're happy because I emphasize memorize the T account, and it will be easier. Now, amortization, let me go back. Let's say you have a building. A building is depreciated 27.5 years. So every year for 27.5 years, you are going to be depreciating every year. And that's what your accountant will do.
And then
amortization, on the other hand, it's for items that organizational costs that it doesn't have, they're not tangible, but usually organizational cost is something that you spend before you open the business. Anything that you pay before you open the business is an organizational cost. And what I do with my client is I give them an Excel spreadsheet with a list of things that could be organizational costs. And you just amortize it. And again, that is not something you do. That will be done by your accountant. But if you want to learn about depreciation and amortization, you go into the IRS website and you just put depreciation. And let me tell you, there's going to be pages and pages and pages. I remember doing that by hand years ago, not anymore. And now I pay money to have it done through programs.
And then the raw materials, should they be categorized as under inventory?
No, raw materials is part of your purchases. Raw materials are part of your purchases because raw materials is something that it has not been finished. It requires other items to make a product. What you do at the end of the year is do the inventory to see how much you have in inventory. And that's the relationship on the cost of goods sold. You will reduce your purchases by the raw material that is in the books. You do a journal entry and you get the ending inventory on the balance sheet. You will get it right here, where it says merchandise inventory.
Just give me 1 second. All right. Then I have another question in the chat. Okay. If you have to purchase a sample product to show clients when you're presenting your service to clients for potential machine placement, where do you track the cost of the sample? Is it included in the inventory column?
No.
And then secondly, organizational costs. Are there the taxes and licenses that you pay for?
Taxes and licenses, no, that's an operating expense. And I'm sorry, what was the first half?
And then the first question, it's in regards of the sample products.
Oh, the sample products. Okay, the sample products, you will create an account called sample products. Because you are not selling them. You're either giving them away or they're going to become obsolete because I have a client that he is a distributor and he has people working at different supermarkets, Publix, Sedano's, Presidente, and he buys the samples, the coffee, whatever he gives them, or the machines. So we have an account that we put at samples. And then we don't expense that until they're dead, but it's not part of the balance sheet at the beginning. It will become part of the income statement as a sample expense.
And that's where folks can also put like their marketing budget as well, right? For like any expenses.
Well, no, it depends on when you do the marketing. Do you do it before you start the business or do you do it after you start the business? Because marketing before the business is considered research and development because you're trying to figure it out, what you're going to sell, what are you going to be doing?
Okay. Okay. You definitely got a good shout out, Lillian. The good information about the balance sheet. helped understand with the costs. So good job.
Thank you.
Slides.
One thing that I need to emphasize is that we are here to help you at no cost. And that's the great thing. That's the great thing. You can learn so much from us because all of us, we have experience in certain areas. Now, don't talk to me about marketing because I would talk to Jesus about it because he's an expert on it. I'm not. I mean, talk to me about numbers and where things go in the chart of accounts, how to read financial statements, how to get you out of trouble, how to make you profitable, as long as the numbers are there, right? So to get along.
Okay, so then so marketing after the CO is made, where does it goes?
After the CO, what is CO?
Tanya, just let me know where what does CO means? Oh, company, after the company. So marketing after the company.
Marketing after the company is registered and it's already in business. That goes under this one account that I always open. I don't separate marketing for advertising. I open a chart of accounts called advertising/marketing expenses.
Okay.
Usually marketing and payroll are the highest expenses in a business. But you need to have enough profits like this company I just showed you. There's something wrong with this company. It's spending more money, 101% on payroll when there's not enough income.
Yes, it's very, very expensive.
Yeah.
Yeah, and then obviously I've been getting a lot of inquiries of how to become clients of Lillian's. In the chat, I've also put in the link to go ahead and register for a consultation. And like that, we'll be more than happy to connect it with Lillian along with our other spokes under the Navigator program. Once again, it is confidential and no cost to you, along with a vast variety of workshops that we have available. And in addition, I will be emailing you of some upcoming events that we have, as such a resource fair that is taking place in Doral next week, Tuesday, from 10 to 1. So by all means, like that's a good opportunity for you to put a name to a face. I will be there. So it's a great opportunity to meet you in person, but at the same time, meet our other navigators as well on how we can continue assisting you. And then Lillian, I have a question for you. What about the SBA loan? How can we find out if we don't have to pay it back? Is there any information about that, please? So I'm assuming.
Okay, there is you sign, if it is an SBA item, it's a loan. You cannot get away with it. It's an SBA loan and you sign the LANA loan agreement and authorization where you say you're going to pay it back. The interest rate is 3.75 and it's about 30 years. You cannot get away with it. It's a loan. The beauty of it is that the interest rate is low and it gives you many, many years to pay it back. What I was forgiven was the PPP, but if you didn't work on it before May of this year, it's a loan. The PPP became a loan. And there's no way of getting in touch with them to forgive you because a lot of clients didn't follow up because of acknowledge or didn't know how to do it, did not know that we can help them with that because we did. How many millions of money did we help with Jesus with the SBA IDLE and the PPPs? A lot of money.
Overall, like the SBC helped our clients get close to $119 million. And that's including from grants, IDLEs, PPPs, traditional, non-traditional capital.
And on top of that, we assisted them with the decline letters, and they were able to get, the majority of them were able to get the money after the fact. Yep. So an SBA IDLE loan is a balance sheet account. Why? Because it's a liability. Why? Because it increases us on the credit side. The PPP loan becomes, it's a liability until you're forgiven. So it's on the liability on the credit side. And then if you're forgiven, it becomes part of the other income. because you're not in the business of having PPP loans all the time. It just becomes other income. And the purpose of that is to be able to prepare the tax return. But it should not affect the banks when they're treating you or considering you for a loan.
All right. Yep, I don't have any more additional questions. So I want to thank you for attending today's webinar. Like I said, this webinar is being recorded, so I will be able to email you the link along with the presentation as well. And then also, Lillian, in terms of the disaster loans, should it be disclosed in the tax return?
What?
The SBA loans?
It's part of a Schedule L of when your accountant prepares the tax return. What you need to make sure is you talk to your accountant and let him know, give him a copy of the LANA, the loan authorization agreement, so that he can put it in the books. If you don't handle the books, let him put it in as a liability. That goes on the balance sheet, is Schedule L. If you want to write this down, Schedule L on the corporate tax return, whether it's a corporation or a partnership. If it is an LLC, one member, it's not going to go anywhere because it's just a Schedule C. And on the Schedule C, you just put the revenue, the expenses, and that is it. You already, in a sense, you don't have to keep track of it. But that's the beauty of having QuickBooks, because you can keep track of it, which is important because you can do projections. Let me just go back in here for a minute. Let me show you something. You see all these projections that I did in here? It was just a click of a button in QuickBooks. So it's very simple. And the hard part and the easiest part for us to teach you is the analysis.
And then in the time being, as Lillian, as you're going over, just to give you a heads up, I have yesterday afternoon is when the email was sent out of the presentation, the link. If you haven't received it, just please email me directly, and I just put it in the chat, and I'll be able to resend it to you. That's not an issue. Okay. I do apologize. Last week I was at a conference, so it took me a while to upload it. But yeah, so everything was uploaded yesterday, so immediately you have received it. But check your spam mail. But nonetheless, doesn't matter. I'll be able to resend it to you. That's not an issue.
Jesus, would it be possible before, are you going to send the presentation as well?
Yes.
Would it be possible that you can
Yes.
add page
Yes.
2?
I already made the
Okay,
note. I already made the note.
Thank
You're
you.
good.
Thank you.
No problem. Okay. So if there is no additional questions, I'll pass it back towards Steve to do the closing remarks, and we'll take it from there.
Thank you, Jesus. Thank you, Lillian, so very much. As usual, very enlightening. And from the comments, Lillian, I think people, they've expressed some real gratitude for this evening. Again, everyone, we're here to help in whatever way that we can. Feel free to reach out to us, and please note that the next meeting, the next training is next week, Tuesday. And then at the end of the month, the last Friday in September, is the in-person introduction to QuickBooks. So again, everyone, Jesus, thank you so much. That tonight could not have been done without Jesus, everyone. I just really need you guys to know that. I want to say thank you to Luby Sumlar, who is a micro mentor at Branches. I want to thank our expert presenter again, Lillian, for an excellent job, Lillian. Thank you so much. And everyone, again, my name is Steve Arman. I'm the director of the micro business program at Branches, and it has been a pleasure. Good night to everyone.
Take care.